Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Let's get to the Treasury and rates trade and the latest on the Fed. Fed Bank of San Francisco President Mary Daly said the labor market is softening, indicated also that the U.S. Central Bank should begin cutting interest rates in coming quarters. She stopped short, though, of concluding the labor market has begun seriously weakening. She made the comments Monday in a moderated discussion co-hosted by the Hawaii Executive Collaborative.
We will make policy adjustments as the economy delivers the data so that we know what is required. If we reacted on one data point, we would almost always be wrong.
Kind of loving the lay there. Federal Reserve Bank of San Francisco President Mary Daly on Monday. So watching the Fed for us, as she always does, Bloomberg's chief correspondent for global macro markets, Liz McCormick. She also writes about the dramatic Monday rally in treasuries, how the moves are laying bare anxiety that the U.S. economy is sliding into recession and that the Fed will need to start aggressively cutting interest rates, something we talked about so much in the last 24 hours. Let's see how Liz sees it on a day when we also get another treasury auction. She joins us in New Jersey. So Liz, how do you see it? We haven't had a chance to talk to you about yesterday's moves and then the aftermath. So what's notable for you? Here we are kind of 24 hours after some thought the sky was falling in when it comes to the financial markets.
Right. Yeah. And I was listening to your conversation with Abigail, and I think some of it from equities kind of dovetails into the bond market. But I would say, so Mary Daly and Austin Goolsbee yesterday kind of calmed the market down in the ISM services yesterday. So we have rates higher. The auction did go through earlier, and we saw good demand, although rates have continued to kind of creep higher since. But I think what we've gotten to in 24 hours is that what I think is really interesting is so I think we've taken the mayhem out of it, meaning the pricing that we had at a peak of 60% for an intermeeting cut. So as soon as next week, that's kind of gone away. But if you look, even though the pricing has come down, still the greater likelihood the market sees is a 50 basis point cut by the Fed in September, which to me, Carol, really says that the market still sees the recession coming, right? If you look out in the trajectory of derivatives pricing, they've got almost 200 basis points priced in over the next year. If you look at our MIPR page, I love that MIPR page on Bloomberg, you can see how they see the Fed funds rate going over 2 and 3 years, and the most of it is over 2. So I think the market, what they had retained is, hey, we are seeing a slowdown, recession or not, where it looks like the Fed's going to move, and they could move quite aggressively. Not next week, but, starting in September, it could be 50.
Well, I was reminded this morning by Tony Dwyer about how aggressively the Fed moved to the upside. I had forgotten that after the first 25 basis point hike, they hiked by 50, then 75, 75, 75, 75, and then another 50. It was
aggressive, super
very aggressive. And you know what? Maybe that was what they had to do because they were behind the curve, right? If they're not behind the curve now, I guess they can afford to go 25. But if they need to, do you think they're willing to move 50? Do you think they're willing to move 75, Liz?
Oh, yeah. I mean, they are totally willing to do whatever they need to do. They don't panic, but they always come in and do what they need to. And in reality, I don't mean to say, I've been around for a while, that it means nothing. But like you said, on the upside, and a lot of people didn't see that coming, 75, all those big moves to the hikes. I think if the data, they'll have the second jobs data, of course, more inflation by the September meeting. If it has a flavor of last week's, 50 basis points, they don't like to surprise the market. The market's already priced for that. So it's easy. I talked to an investor today who said, Liz, come on, if they start and they do 50, they do 450s and it's 200, you know what I mean? And they can do that if they need to. Like it's not that out of bounds. So I don't think them going 50 is out of the question. It's like the kind of, like I said, the panic, which made sense with all the unraveling of the carry and the kind of mayhem that they could go, they're going to jump in and do it, tomorrow. That's not usually the way they move.
Hey, Liz, how much of what we kind of saw yesterday is just a reminder, maybe the market's sending a message that traders, maybe were mispricing and recalculating and not thinking enough about the downside risks to the U.S. economy?
Yeah, I mean, I think that like the big take that's on our screens today is really good. It looks at everything that happened in the last 24 hours, but it kind of got to this kind of Goldilocks globally that we thought, which would never go away, right?
Right.
The U.S. economy would just plow on forever. AI would drive everything. The Bank of Japan would never really tighten much. And all these things. We've seen it before. Like the saying, it works until it doesn't, right? And then it keeps going until things unravel. Who was it, Greenspan, that say you could say kind of irrationally exuberant for a while, or I'm mixing his metaphors, but you get the point. But that I think it goes on until it starts to not, and then people say, oh wow, like someone said to me yesterday, people thought, oh wow, maybe there is a recession trade and I better get in it. And I don't think, like we were joking, dead cat bounce. Yeah, I don't think one day of calm anyone is saying, oh, the worst is over. They're praying and hoping for some more stability, but we have a long way to go. We have jobless claims on Thursday, which is the kind of, to me, the key data this week. And then we only have a few Fed speakers, but I think they'll probably dovetail what Goolsbee and Daly said. And we have 2 more auctions, so let's see how it all goes. I
think you may have been looking for the John Maynard Keynes quote, which is, the market can stay irrational longer than you can stay solvent.
That's the one I wanted. Thank you, Max.
Did you Google?
I Googled it. I mean, I just wanted to know to whom it was attributed.
That's okay.
But I love the saying. And obviously it's true. Just ask somebody who's got caught on the wrong side of a carry trade, right? I mean, if you had to pay back a contract when the yen was at 160, and all of a sudden the yen is at 140, it's a lot more expensive for you to do that. So you're going to try and get out of it quickly. By the way, Liz, do you know of anyone who has come up with a good way to measure how big the carry trade is, or how long it would take to unwind? I mean, I was talking to Aoifinn Devitt this morning. She said it's about $4 trillion, which pales in comparison to the size of the market, right? But it's still a big number.
Yeah, it's a huge number. It's definitely multi-trillions. I know you were talking about the JP Morgan analysis that it says it's like only halfway done. The BIS, every now and then does a good deep dive on it. But it's I think we talked yesterday that it kind of goes away and then it plows back on. It's definitely multi-trillion, and it's not going to take one day of brutal movement to end it. So I think it's there. We've seen these kind of weird derivative structures. I don't want to get too wonky. After 2008, some of these kind of esoteric options, it wasn't the carry trade, but other things that started unwinding, and it just ripples through. And I think, like you were talking, it's also for the bond market about market functioning. So for now it's functioning, so we're okay.
Fingers crossed. Good stuff. Liz McCormick, thank you so much. Bloomberg's chief correspondent for global macro markets.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Also impressive today, what's going on with Uber? Stock pretty much at its highs of the session, up 11%. Let's get to it with Mandeep Singh. He's Bloomberg Intelligence Senior Tech Industry Analyst, joining us right here in studio. I think the stock's jumping the most in more than 6 months. Good earnings, great earnings, good outlook?
Good earnings, good outlook. And with Uber, the story is the same. Half of their business, the ride-sharing side, looks very healthy in terms of profitability, top-line growth. The delivery side is barely profitable, although they are trying to layer as many categories as they can, from grocery to convenience to retail delivery now. So they're like Amazon-esque in terms of last-mile delivery. It's just the business isn't profitable. They're even layering on ads. And I think that's what give investors hope that they will turn to profitability on their delivery side. But it's still the ride-sharing business. And the one caveat I would say is everyone is thinking robotaxis are 5-10 years out. If Waymo or Tesla scale it up in a way where even if they take like 5 to 10% of the share of rides, that will be disastrous for Uber's take rate. So that's a big risk that investors have to account for when they invest in Uber.
I can't believe that the delivery side of the business is profitable or sustainable. I mean,
you mean long term?
I've used it a couple times. By the time the food gets to you, it's cold and soggy. The guy is an Uber driver, not a professional, food preparer, or it just doesn't make any sense to me that this is a business that they want to stay in for the long haul.
So there are certain markets where they have turned profitable, in terms of the delivery side of the business. And the reason why it's got better unit economics is, imagine a Domino's or a McDonald's delivery. Now,
I can't imagine that. Why would you do that to yourself? I mean, the health effects of that are just downright awful, not to mention the taste.
Any other QSR, even a Starbucks. So that's where, an Uber can get you that incremental orders that Starbucks isn't going to deliver themselves. It's just not profitable for them. So they have the scale. I mean, the thing about Uber being a verb is everyone thinks about them when it comes to ride sharing. Yeah. And that has translated to scale on the delivery side. It's a tough business when you layer in insurance cost and, the other cost to keep the food warm and everything. It's not a technology type of margin business.
So why do it?
Well, I mean, their focus for the longest time was to build scale. I mean, look at the scale of this company, $150 billion in bookings. And, $40 billion revenue run rates. That's huge.
Yeah.
So even a ride-sharing threat from robotaxis, look, nobody can match Uber scale. The risk there is, what if they get disintermediated? What if Tesla says, we are going to launch this service on our own without using a ride-sharing network? And that's a big risk because the unit economics change once you take out the driver and the car can drive on its own. And look, Waymo is doing it successfully in 3 cities in the US. You go to San Francisco, you can take a Waymo ride. So even if they take 5% share of San Francisco rides, it's going to put pressure on Uber's take rates. And that's where that 30% take rate they command is probably the best in class for any marketplace. And there is the risk for that compression because Waymo could take some of that volume out of Uber's rides.
How is the relationship with cities, with major metropolitan areas where, they just provide a ton of congestion? And how is the relationship with drivers who, in some cases are stretching to make car payments and
I've heard a lot of complaints every time I get in an Uber.
Yeah, because they continue to ratchet up the
Yeah.
amount of money they're taking out of the driver's pocket. So.
Exactly, and that's where the take rates come into play. If Uber is taking 30% blended take rate, in some metropolitan areas, their take rates are as high as 45%.
Wow.
That means if it's a $50 ride, Uber is taking, a good chunk, $20 to $25 off that ride. And I think that's where the drivers continue to feel they're being underpaid. And then the Prop 22 aspect, which Uber won in terms of not having to treat drivers as employees. But that's always a risk with, different jurisdictions, different cities. And I think that risk isn't going away. It's still, Uber is the scale player. So compare that to Lyft. They're in a much better spot.
Yeah.
But DoorDash is actually the scale player when it comes to delivery. So Uber, I think, again, I'm not very hopeful on the delivery side simply because DoorDash is doing so well on the delivery side.
Well, also doing well, shares of Uber, as I said, still up about almost 12% here. Mandeep, thank you so much. As always, Mandeep Singh breaking down Uber's earnings and outlook. Bloomberg Intelligence Senior Tech Industry Analyst right here in our studio.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Hey, among our most read stories on the Bloomberg today is about the yen carry trade, something Matt highlighted a lot yesterday and we continue today, and how the recent unwinding in carry trades has more room to run as the yen remains one of the most undervalued currencies. This is according to JP Morgan Chase's Arnim Sandilia. He's co-head of Global FX Strategy earlier on Bloomberg Television.
Looking at the various suite of positioning metrics we have, we think that the carry trade unwind, at least within the speculative investing community, is maybe somewhere between 50 to 60% complete. So we are not done by any stretch.
All right, let's get over to Aoifinn Devitt right now. She is a CEO at Moneta, CIO at Moneta. And I actually spoke, Aoifinn, with you earlier this morning. It was a great conversation. And you pointed out that we think the yen carry trade is about a $4 trillion, block in these markets. That's not unbelievably huge, but it's still a significant amount that needs to be unwound, right?
Exactly. Of course, markets are always looking for a narrative for any kind of plot twist or development, and that was clearly the narrative emerging from yesterday. And then I wanted to dig a little deeper to say, well, okay, clearly not everybody in these momentum stocks was executing it as part of a yen carry trade. So how much are we actually talking about here? And how much is it really driving markets? And the number 4 trillion was out there. And if that's the case, clearly there were a lot of perhaps yield hungry investors seeking to spice their returns with leverage, because yen was one of the few areas where perhaps one could borrow cheaply. So I don't know how pervasive it was. Certainly, if 4 trillion is the amount that's in it, that is meaningful enough to move markets. And that could have been part of what was driving it yesterday. If it was the carry trade being unwound, there's certainly been a lot more appetite for the yen and for Japanese equities today. So difficult to say just how pervasive it is, or whether that was just the market jumping on a narrative.
So are we kind of dumping on the wrong narrative? You say if the yen carry trade was unwinding, it sounds like you have a lot of questions about that narrative.
Yeah, exactly. Because as I said, what percentage of the buyers and sellers in the market at any one time are in this speculative camp? Very few. This would generally be more professional investors. And as we know, what has really dominated has been momentum. And of course, the large amount of ETFs and passive investment that would have been buying into these market cap weighted trades. So like such as the Magnificent Seven. So the vast share of what has been in US equities and driving them higher is not speculative money. So therefore, one would question how much is being in fact unwound. I don't think that was the reason there was a sell-off yesterday. I think it was just the culmination of a slow drip feed of slightly worrying news, which in culmination became quite worrying. Not yet very worrying in that we were not tipping into recessionary territory, but it was enough to move the needle to lead to some profit taking. That's what I think was actually going on yesterday.
I will say, interesting. As a journalist, I was watching the geopolitical news get bad at the same time. For example, after Israel assassinated the leader of Hamas in Tehran, I thought markets would tank on Wednesday. They did not react negatively, but maybe it makes people nervous. Add to that the fact that we're not getting great news in terms of when is the return on investment for artificial intelligence spending going to come. Then we get a non-farm payrolls number on Friday that's not amazing and starts a sell-off. But over the weekend, what really got me is that Warren Buffett, who is the Oracle of Omaha, right? America thinks of this guy as the greatest investor of all time, has started to sell not only his Bank America stake at a pretty steady pace, but cut in half his stake in Apple, which is like the all-American stock, right? It's the GE of our generation. So is that what triggered the huge sell-off we saw yesterday?
It's a culmination of all of that. And yes, perhaps it started overnight in Japan, and that did not set markets on the right tone, certainly on a Monday morning. But when we look at that, it's interesting you mentioned geopolitical risk, because what has been a real hallmark of recent markets has been their resilience around geopolitical risk, their failure to react. They seem somewhat insulated, very focused on the numbers, very focused on corporate health, consumer health, and earnings. We've seen time after time again shocking geopolitical twists and no effect on markets. So that isn't in itself a surprise. I would think the Warren Buffett news is somewhat of a red herring, could be completely coincidental and not at all a driver of any of these fundamentals. There could have been profit taking. Who knows his logic behind that? Certainly he would be taking significant profit. So again, just this culmination of random events really piling up. And remember, the rotation has been in effect now for weeks. We've been talking about this. So if that is really the slow burn of some of the unraveling of the momentum, well, then now we're at a place where we're actually jumping on new narratives. And if you remember, even yesterday we were talking about rate cuts being not in the 25 basis point level, but at the 50 basis point level. So we're really jumping to new conclusions there. So I think we probably all have to calm down a little and not be as prone to having a 180 plot twist based on a market event like Monday.
I mean, the rotation happened and then got completely unraveled. Look at the Russell 2000 graph, and you'll see that all the gains we got at the end of July were completely erased. And I think it's, Aoifinn, I agree, theoretically that the Berkshire selling maybe shouldn't be sending us a signal, but everybody over the weekend and yesterday was like, there's nothing to see here, move along, do not look behind the curtain, and then this guy's the wizard. So I think it spooked retail investors.
Yeah, I don't think you're wrong. Well, so I am curious, Aoifinn, so what do you focus on right now to figure out whether this was a bit of a correction, market's correct, right? And then investors decide where they want to go or they come back in? Or is it something more troublesome, worrisome, with some legs to it, some teeth to it?
I did not see anything that would put me in the worry camp. There was no event, there was no credit event. This was nowhere like what we saw in the regional banks in spring of last year. That was the type of thing that could have been seen as a canary in the coal mine. There was no suggestion of a fraud, say, at one of these large tech companies, or at some evaporation of demand, or as a fundamental use case for AI being undermined. All of these were the fundamentals. If we look, certainly there is a slow burn in terms of consumer optimism, and the employment rate is ticking up, and all of these economic indicators are starting to look a little less positive. But remember, inflation's getting into the rearview mirror. The Fed has arsenal, it has essentially ammunition in the tank now to stimulate the economy if it needs to. And based on yesterday's narrative, it could have gone big at that. So I'm not really concerned. The fundamentals to me are very strong. This is why you want to have core exposure across sectors so you can capture the rotation and that you can then be therefore well positioned for markets returning to a somewhat more normal state, which is to not have that level of concentration that we've seen so far this year. I don't see anything to worry me at this time, but clearly a big geopolitical surprise that could be undermining perhaps in terms of the balance, the power balance, something a negative surprise on trade, that could push inflation upwards. That would be worrying, but none of that has happened.
So great to check in with you. Really smart conversation 24 hours later from what we got yesterday and certainly over the last week or so. Aoifinn, thank you so much. Aoifinn Devitt, she is Chief Investment Officer, Chief Global Market Strategist over at Moneta Group, joining us.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody. Just about 18 minutes left in the trading session, and we're off our best levels of this session in terms of the equity trade. But still up. Still up.
Almost 2%. I mean, yesterday we lost 3% on the S&P 500. It was down Friday. It was down a little bit Thursday. So we haven't made that back. No. But there hasn't been a reversal. And I have to say, I knew there would be a turnaround from watching Asia overnight. But I thought from the European markets that we would have a bounce and then start to come back down, and then the dread would start to mount and it would get worse and worse and worse. So this is pretty good.
Yeah, and considering we just have under 18 minutes left here, if we see, I always like to see what happens into the close, whether we see some selling as we wrap up the day. Let's see what our next guest has to say. It is time for the drive to the close. Arnim Holzer is Global Macro Strategist over at Easterly EAB Risk
I believe
Solutions.
It's Arnim Holzer.
Oh, did I not say that? Arnim?
Arnim?
Oh, did I say Arnim? I'm sorry. Arnim.
That's how it would be in German. I don't know.
He is the expert. How are you? Do we have audio there?
He's muted. Arnim, you're muted. I think you've got to unmute yourself.
It is Arnim.
Oh, okay.
It is Arnim.
My apologies.
It's a pleasure to be on with you all today.
All right. Well, it's great to have you here. How's this day feeling in comparison to yesterday?
Well, obviously, there's been a lot of tumult. There's been a change in narratives, but this isn't just about what happened with the carry trade. We've actually seen some regime shifting around what the market is expecting in terms of Fed policy and a programmatic set of easing that they're obviously desiring, but also a set of election outcomes that the market was positioning for. And so you've got this confluence of events. And actually, I think today isn't really telling you much because we're still kind of running up against this resistance of 528, 529 on the S&P. And if we fall short of that, I actually think the message is there's a little bit of an unwinding of the narratives.
So how much further do we have to go, especially considering how intense the run up was, right?
Right. First of all, I think equity investors have a narrative that they've been pushing. And Matt, Carol, we know that they've been pushing this narrative for well over a year. Mm-hmm. And every time they get disappointed, there's a hissy fit, there's a shock, and volatility moves. But the difference this time, I think, is that with the unwinding of the carry trade, you began to see that some of the excesses of the post-COVID, of the COVID and post-COVID period, we added to the reconciliation, to the disintermediation of fiscal, of monetary, and then of the reality that the Japanese source of liquidity may not be unimpaired, may be somewhat impaired going forward. And when you look at those things, it was too much for the market to digest at once. Obviously, the Trump, change in Trump election odds also had an impact. But I think most important is this idea that either the U.S. is going into a real recession, which does have an impact on sectors and rotation, or it's going to avoid that, and the Fed is going to ease into slightly less punitive inflation to give the market kind of this Goldilocks scenario. That is coming into question here because it's very much in the equity mind that a softening of economic activity is going to change analyst expectations. It is going to change the earnings expectations, which really to date have not really changed much if you look at the S&P and the breakdown. So there is this need for the Fed to come in and give a little support if in fact there is maybe not a big R recession, but a little slow down, little R recession.
You sound pretty calm.
But you sound skeptical. I mean, where do you think the S&P should be? I mean, take out the fluff, take out the froth, take out the story, right? And what's fair value?
Well, at Easterly AB, we advise clients on where the asymmetry is. We like to look at what is advantage from an asset allocation point of view, because it's very hard to know, should the SPX be at 5150 or 5100, or should it be 5400? It's very difficult to know. But what we do look at is where is volatility? Where should volatility be based on the open items, right? If you look at correlations, should bonds and stocks be correlated? Now, in the last week, just to give you a sense of how silly some of these moves are, in the last week, the correlation of TLT, of 10 to 20-year bonds and equities went from being relatively positive to, in the 35, 40% range to the 60-day correlation is now actually a negative, 0.5% or 1%. Has there really been enough clarity in the in the Fed's program to justify a 30% change in 60-day correlation within a week? I would say no. And so what we like to do is say, if you're a betting man here, what you want to do is diversify, and you want to make sure that you're not so levered to one of these narratives. The Fed is going to ease 6.5 times by January, or the Fed is not going to ease at all. What you want to do is look at where are the earnings secularly advantaged, and where is the room as an investor for you to not be hurt and take advantage of volatility. Because if you look at these changes, particularly the Japanese carry trade unwinding, it would imply that vol should be higher. Now, granted, you all just mentioned it, the level of the VIX, had peaked over 60, and it's now down in the mid 20s. But is it coming back to that 12 or 14 level that it was, at the end of July? I don't think so. We would say that you're probably going to be in a higher vol environment.
Right.
And that has impact for credit, obviously, and that also has impacts for asset allocation.
We're at 26 today on the VIX, so we've definitely come down, obviously, from where we were yesterday. But
66 yesterday.
But we've seen a lot of, I feel like we've seen a fair amount of swings in the market this year, almost from data point to data point, expectations to what the Fed might or might not do. So with that in mind, what are your suggestions? And we've just got about, 50 seconds, 40 seconds here. Arnim, what do you suggest investors do in this environment? How much do they need to change? What do they do?
Great question. Firstly, you need to understand where your correlation risk is. Just because fixed income is giving you a yield doesn't mean it's necessarily the diversifier, because correlations have been positive. And my sense is correlations are going to go back to positive again because the Fed policy has to be decided. I'm concerned about credit because any rollover, and we're seeing analysts start to wonder about consumer numbers. And if the Fed doesn't come in soon enough, then you could see softening, and some of those numbers on the consumer side have to be softened. And then the third thing is investors should really look at, if volatility is going to be higher, they should look at the kind of alternatives, things like hedged equity, alternatives that can actually collect on volatility.
Right.
You need to incorporate some of those strategies because volatility is likely to be here until the Fed makes clear what they're going to do.
All right, got to run. Hey, great to check in with you. Arnim Holzer, global macro strategist at Easterly EAB Risk Solutions. They've got over $60 billion of client assets under management.
Easterly Asset Management and its strategic partners.
Thank you very much.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.